All right, let's get right into a real head-scratcher from Wall Street. Bowhead Specialty, a big name in specialty insurance, just dropped their Q2 numbers. And on paper, they looked fantastic. Absolutely stellar. But the stock, it went the other way. So what's going on here? Let's dig into this beat and drop paradox.
So here's the big question, right? A record quarter, and the stock drops almost 4%? How does that even happen? Clearly, the market saw something that wasn't in those shiny headline numbers, and that is exactly what we're going to unpack today.
Okay, so first things first, let's look at why everyone was so confused. Because honestly, if you just glanced at the highlights, you'd think the stock should have soared. Management was definitely doing a victory lap. And you can't blame them.
Let's kick things off with their top-line growth. We're talking about gross written premiums here. That's basically the total value of all the insurance policies they sold. And that number shot up by over 32%. I mean, that's huge. It screams massive demand, a business that's firing on all cylinders. A super healthy sign, right?
And this wasn't just empty growth. They were actually making money. Their adjusted earnings per share, or EPS, hit 37 cents. Now, the Wall Street consensus, what the experts predicted, was 36 cents. So they beat it. It might only be by a penny, but a beat is a beat, and that's always a big deal. But check this out. The bottom line was even more impressive. We're talking net income, the pure profit left over at the end of the day. It more than doubled compared to last year, a 123% jump. That's the kind of number that usually sends a stock to the moon. So, let's just recap for a second. Bowhead beats on profit. They beat on revenue. In Wall Street jargon, that's called a beat and beat. It's pretty much the gold standard for an earnings report. You can't ask for much more. And yet, the stock went down. The plot thickens, right? All right, so to solve this mystery, we have to peel back the layers and look past those big, flashy numbers. We need to get inside the heads of the big investors and see what they were looking at, because buried in the details were a few red flags that raised some pretty serious questions. And this is where you see the big disconnect. You've got two totally different stories being told. On one hand, management is out there talking about record growth and scaling expenses. But on the other hand, the market, they were laser-focused on something way more subtle, a shift in the kind of insurance Bowhead was selling and what that might mean for risk down the road. And that big risk has a name: social inflation. Now, this has nothing to do with the price of gas or groceries. Think of it like this. It's the rising cost of insurance claims because society is changing. People are more willing to sue, and juries are handing out way, way bigger awards than they used to. This is a massive headache in casualty insurance, where a claim that used to be maybe $2 or $3 million could suddenly balloon to over $10 million. So this all boils down to a few key worries for investors. 1, the company is selling more of that higher-risk casualty insurance. 2, those loss cost trends we just talked about seem to be getting worse, not better. 3, the company's loss ratio, which is a really important metric, actually ticked up a little bit. And 4, management didn't give any specific numbers for their full-year forecast. That kind of uncertainty, investors hate it. It leaves them guessing. Okay, so the market is clearly worried. But what did Bowhead's leadership have to say about all this? Let's hear their side of the story, because they've got a plan to tackle these concerns head on. During the earnings call, the CEO, Stephen Sills, laid it out plain and simple. He said, and I'm quoting here, "From the top down, underwriting profitability is our North Star." What he's saying is, look, we're not just growing for the sake of getting bigger. Every policy we write has to make financial sense. It's all about profitable growth. So how are they going to do that? Well, they've laid out a 3-part strategy, which is basically their answer to all those market jitters. Step 1, be super disciplined about the risks they take on. Step 2, get more efficient. As they get bigger, they can drive down their expense ratio, and their goal is to get it under 30%. And step 3, lean on their new tech platform, Baleen, to smartly grow in areas with smaller, more manageable risks. And management was quick to point out, hey, don't get too hung up on the casualty segment. The reality is they saw strong double-digit growth across the board. I mean, their healthcare division was up a whopping 39%. So yeah, the mix is shifting a bit, but the overall growth engine is absolutely roaring. So there you have it. 2 competing narratives, right? On one side, you have these incredible, record-breaking numbers. On the other, you have these lurking, hidden risks. So what now? Where do we go from here? Well, let's talk about what to watch for, because the next few months will decide which one of these stories is the real one.
First off, it's important to realize this isn't just a one-day blip. If you zoom out and look at the last 3 months, Bowhead stock is down almost 15%. Meanwhile, the broader insurance sector is basically flat. So this tells us that investor nervousness isn't new. It's been building for a while.
So the next few months are going to be crucial. Keep an eye out for these key events. In early November, we get the Q3 earnings report. That's the next big data dump. Then, later in the year, they do their annual review of loss reserves. That's where we'll see exactly how they're preparing for that social inflation risk. And all along the way, you can bet analysts will be glued to renewal pricing trends, looking for any sign that things in the casualty market are starting to stabilize.
And that brings us right back to where we started. Is this whole thing just a classic market overreaction? Did investors get spooked by shadows and miss a great quarter? Or is the market being smart, looking ahead and pricing in some very real risks that are hiding just beneath the surface? Honestly, that is the billion-dollar question, and the answer will play out over the next few quarters.
And as always, just a quick reminder, this is purely for informational purposes. It is not financial advice.